was working on finding actual jobs for yourself.
Oh. That one is not like a ticket.
Looks like we have one dead projector. Which isn't good.
It's a case study, but basically, you have some questions. There'll be two. There'll be some questions, and then there'll be some. With some financial documents.
Okay, I'm gonna get started. It looks like that overhead is dead. For those of you who are reliant on the screen, you may want to shuffle yourself over so you can see this one, or follow along online. It's fine. So I'm going to start with a recap of the very end of last class and then roll into the next subject. But before I do that, I want to cover off on a couple administrative notes. The first one is a number of you have been trying to get in to see me on office hour stuff. And some have been drop-bys, and normally if I'm there and the door's open, feel free to swing in. My schedule is getting, just like yours probably, a little bit hectic toward the end of the semester. So if in doubt, schedule something online with me. You can go into Outlook, use the calendar function, schedule an appointment. You'll see that my schedule is in there. It should be up to date. Drop your name, find a block, drop your name on there, and or stop by my office, which is 206 Old Main. Talk to Emily if I'm not there. Emily will schedule something for you. I know it's getting close to crunch time, end of the semester. Those of you who are student athletes in spring sports, I know tend to be awful darn busy as well. So I want to be sensitive to that as far as making sure that you've got the time that you need in order to be successful. As a reminder, most of these lectures have been recorded and are up on YouTube. Now that doesn't mean that the audio is all that good or that you can see the slides, although you can generally follow along. And if you're following along, you'll notice that since I don't have a clicker every time I walk over to my computer, I hit advance the slide. You can pretty well follow along yourself because you'll see my face loom in the camera every time I change the slide. So you can follow along online if you miss a lecture, or if you want to go back and check on something you may have either missed or want a refresher on. But we are getting close to the end, and I will tell you it feels pretty good. We've come, I believe, a long way from what is finance to finance is, and we're going to finish up finance is with how do we now apply it in the firm. And we started that last couple weeks with capital budgeting. So I just want to cover again the tail end of last class, which was when you've got multiple projects and you're looking at a weighted average cost of capital and a marginal cost of capital, how do you decide what projects to do? Because if you remember, when you're raising capital, whether it's equity capital or debt capital or preferred stock, you've got to add flotation costs. And as your capital structure changes, your risk profile changes. And as the risk profile changes, the weighted average cost of capital changes. The book uses this concept of breakpoints, which is essentially at a certain point, 61 million, 120 million, all of a sudden you see this pop up in interest rates or in required equity rate of return. That's not necessarily how the real world works. It tends to be more of a linear function of increases slowly rather than you see breakpoints. However, breakpoints become an easier way to be able to analyze it and is pretty clean. So I'll walk through it one last time. We have these 5 projects. They have an initial cost of 39 million down to 25 million. They provide a certain amount of cash flows. They have a certain length of life, and there's IRRs associated with it. The IRR becomes helpful when you're looking at the marginal cost of capital. If you recall, this is our favorite company, Unilite, and here at 61 million, there's a break point. And then there's another break point at 120 million. And so what you end up doing is you plot these, and if you recall, we said you start with the highest IRR first. You go, okay, how much additional capital do I need to do that? And what's my weighted average cost of capital? So my weighted average cost of capital, the first break point is 61 million. The second break point, or excuse me, is 10% to the first break point, is 10.5% to the second break point, and 11% thereafter. Dollars across the bottom, interest rate across the top, or required rate of return. All you do is plot this, each one of these projects in order of highest IRR to lowest, and you end up with the last project you should do, the last project over the weighted average cost of capital, which becomes your R when you're analyzing these projects, is 10.7%. Is project E, which means you don't do project A. And when you figure out how much this plus this plus this plus this is, you find it comes to $115 million. That becomes your capital budget. In the real world, it's rarely this clean, but the concept holds. A lot of times what happens is when we're looking at capital budgeting, we tend to approach it, if we're in the firm and we go, well, you know, this is 10% and this one's 10.2%. And so really all of them are over 10%, 10.5%, this one and everything else is over 11. So we should do them all. And in reality, if you do that, you're losing economic value out here. So put them in rank order by IRR, graph them or compare them, and at which point you cross that break point, the total of your projects becomes your capital budget. And that then becomes the what amount of money do I need to raise to be able to fund these projects? And it's raised as a combination of debt, preferred stock, and common stock, if you're going to hold your capital equation the same. The last two things I wanted to touch on, and we hit on it a few times last class, but I want to emphasize it, is that the return that you get in the firm and the return the investor gets are different. We're almost always different. So when you look at debt, the return on debt is the yield to maturity. That's what the required rate of return for the investor is. For the firm, you've got an after-tax cost because the interest that you pay on the debt, as well as the amortization of bond premium or discount, is tax deductible. And so you have a lower cost to you than is what is received by the investor. So there's always going to be a difference. The investor is going to look at their after-tax required rate of return, but their tax profile is going to be different than the firm's. So remember, your cost is always after tax. When it asks for what is the investor's required rate of return or what does the investor receive, it's going to be before tax, because we're looking at these from the perspective of within the company, not the investor's perspective. And with equity, it's much the same. You've got your required rate of return, or the investor's required rate of return. Your required rate of return on retained earnings is going to be calculated the same way. However, if you're going to issue new stock, you've got this flotation cost, which again, as we saw in the last class, can have a meaningful impact upon the required rate of return, or a meaningful impact upon the return for new equity. In that particular case, it increased it by about 1.5 points because there's a 17% flotation cost. So don't forget that from the investor's perspective, there's a required rate of return, but from the firm's perspective, there's a cost, and normally those two are different. In debt and new equity is always different. For preferred stock that exists, for equity that exists, it's going to be the same. And if you have to issue new debt, equity, or preferred stock, there's likely flotation cost associated with it, which will make that cost differential larger than zero. Any questions on these concepts? Okay, So we go from, here's the costs, and here's what the company looks like, and here's what the cost of debt, equity, and preferred stock is. And we go, okay, so in this particular case, in Unilite's case, it was 45% debt, 5% preferred stock, 50% equity. And that was the capital structure. What we want to look at now is what's the target capital structure? What's the optimal capital structure for the company? Because that may or may not be optimal. And optimal is the ideal mix of preferred stock, debt, and common equity with which the firm is going to not only plan new investments, finance its new investments, but also how it's currently financing itself. And so we want to figure out what the optimal structure for that is. Does anyone want to take a guess as to theoretically what the optimal structure of that would be? Say again? Oh, come on. No? Okay.
30% debt.
Where are you coming up with the numbers? How are you coming up with numbers?
My personal budget.
You're pulling them out of somewhere.
My personal budget.
Okay. So from a theory perspective, the targeted capital structure is one that optimizes the risk-adjusted return to the owners. And so you're kind of on the right track, kind of. There's really 4 factors that influence the capital structure. Each one of these gets blended together to come up with what is the theoretical right answer and a direction that you would want to move your capital structure. The first one is the company's business risk. The beta. How risky is this company relative to the rest of the market or relative to other companies in its area? The firm's tax position. Because if the firm's tax position, if the firm doesn't pay income taxes, say it's showing losses, or the firm has a low tax rate, debt then becomes a little bit more or less. So if the firm has a low tax rate or isn't paying taxes, is debt as attractive as if it's got a high tax rate?
It's more.
I heard a no. And I realized my question was not framed well. So if tax rate goes down, is debt more or less attractive?
It's less attractive.
Why?
Because if you were making, the whole point of you having debt is that you're paying less taxes. So to make yourself more appealing to investors, you'd want to show a profit, even if you'd want to attract cash flows in other areas, because you would then be paying less taxes on them and be more appealing to investors.
So you're 90% of the way there. I'll summarize it a little bit shorter. If you think about what I just talked about, cost is different than the required return to an investor. If a required return to an investor on debt is 10%, and your tax rate is 20%, the cost to the firm is 8%, right? So because you get essentially a discount associated with the taxes. So the cost is the after-tax cost of debt to the firm. You're paying 10% to the investor, you get to deduct the interest, you're at a 20% tax rate, so the cost to you is 8%. If the tax rate rises to 50%, now your cost on that same debt is 5%, because you now get to deduct the interest and there's a bigger tax shield. And on the equity side, your retained earnings go from being taxed at 20% in the first scenario to being taxed at 50% in the second scenario. So all of a sudden, your retained earnings cost goes up, your debt cost goes down, and higher tax rates drive a desire to have more debt financing generally. Financial flexibility. What do you think I mean by financial flexibility? Yes, sir. No, just in general for the firm. What do you mean? What do you think I mean when I say financial flexibility?
Diversified, or you have the option to buy.
Yep, that's part of it. Anybody else? So financial flexibility is looking at your options and saying, okay, how easily can I raise money? How easily can I dispose of assets? How easily can I turn assets into cash? How much of my money is tied up in property, plant, and equipment versus retained or versus accounts receivable and inventory? And so some of that is financial flexibility. How easy is it for me to get another bank loan? Do the markets find the company attractive or unattractive? Because if they find it attractive, it's going to be easier for us to raise money than if we're in a situation where the markets don't find us attractive and we have to work within the means that we already have. And so financial flexibility is going to be important because you may say my optimal capital structure is 70% debt, 0% preferred stock, and 30% equity, and you want to raise $100 million and the markets say there's no way in hell I'm going to give you $100 million. You have no financial flexibility at that point. You might say, they might go, we'll let you raise equity, we're not going to let you raise more debt. So financial flexibility becomes a key component to that decision. And the final one is managerial attitude, which is really where you were hitting, which is how comfortable is management with managing in an environment where you have a heavy debt load, where you have high accountability to preferred stockholders or high accountability to common stockholders, where you have kind of activist shareholders. So management's attitude to the capital structure, to their willingness to assume more risk, to their willingness to manage debt becomes part of the equation. So you might go, hey, the optimal capital structure is 50, 10, 40, but I don't feel comfortable with 10 in preferred stock. I would rather that in common equity, even though it dilutes common equity a little bit. I'd rather have it there because then I don't have to worry about preferred dividends and there's no tax advantage. And it may not make sense when you look at the equation, but it makes sense from an attitude perspective, and that gets weighed in. We're not robots, and in general, if we were, we'd be able to just plug firms into computers and have them run the firm for us, and that would be a bad idea. So there's elements of this where your gut or your attitude are gonna come to play. So we talked through a little bit of these things. Business risk is risk associated with the firm's operations, which includes sales variability, price variability, inputs. So that would be things like if you're manufacturing cars and all of a sudden there's a 30% tariff on steel, and steel is a major component of your car, input price variability and your ability to control that is important. If you have other commodity items where the prices like oil or other things are going to vary significantly outside your control, that's going to increase your risk profile. Your ability to adjust output prices in response to input prices. So if there's an increase in the cost of labor because minimum wages go up, can you pass through that increased cost to your customer? So if you work at McDonald's, or if you own a McDonald's franchise and minimum wage in Washington State goes up from $11.50 to $12.50 an hour over 2 years, and labor is 50% of your inputs, can you increase the cost of a Big Mac enough to cover that cost or not? Or are you limited by the ability to raise the price of a Big Mac because McDonald's says thou must have a $1 value menu and everything on that needs to be $1 and you can't increase the prices at all? In which case your risk goes up because there's a bunch of external factors like the cost of beef, the cost of bread, the cost of flour, the cost of labor, and you're limited by either law or contract from increasing your prices. That gives you higher risk. And to the extent to which costs are fixed, which is operating leverage. And we talked about operating leverage early in the semester, where essentially you have a situation where you go, okay, I can build everything with a bunch of people, or I can have a bunch of machines. People, I can lay them off and I can hire them. My costs are variable, but it's probably more expensive per unit. I could buy $1 million machine and I can pump X number of units through that machine. But if I see a decrease in demand or quantity demanded, I still have to pay for the machine. If I see an increase, I have a step function where I can only go to X quantity and then I got to buy another machine. And so to the extent you have that kind of operating leverage, will have a different risk profile. The more leverage you have generally, the higher your risk, the lower your profit. Or the higher your risk, the higher your profit, because the return should be commensurate to the risk. Because in finance, what we're looking at is a stream of cash flows and a discount rate. And that discount rate is reflective of risk. That's your required rate of return. And so if that risk goes up, the required rate of return goes up, and therefore your profit should go up. But you're also taking on more risk. So if your quantity goes down, you may end up showing losses because of leverage. We just talked through this. Any questions on operating leverage? Financial risk. What is financial risk? Financial leverage is the extent to which fixed income securities, debt, preferred stock, are used in a firm's capital structure. How much are you using borrowed money, money which doesn't participate in the profits, to drive profitability? If you think about the capital structure of a firm and who gets the profits, it's the common stockholder. The common stockholder is entitled to all the profits of the firm after costs are paid. So to the extent you have preferred stock and debt, they don't participate in the profits. And to the extent that the money that you've borrowed on the debt, or that you've gotten in preferred stock from the preferred stockholders, to the extent that you're returning a higher rate of return than you're paying on that debt, than the cost of that debt, the value of that is not going to the preferred stockholders or to the debt holders, it's going to the common stockholder. However, if for some reason the equation changes and a company begins to lose money or begins to slow down, or things like operating leverage start to come into effect, and you don't make enough money to pay the bondholders and the common or the preferred stockholders, all those losses also come from the common stockholder. So financial leverage can amplify profit and loss, because these folks get paid, and whatever's left over goes to the common stockholder. And to the extent that you're earning more on the debt and preferred stock than the required rate of return, or than the required rate of return to the shareholders or the bondholders, the benefit of that goes to the common stockholder. To the extent you're earning less, it comes out of the common stockholder's return. Any questions on that concept? It's pretty straightforward, pretty basic. We've kind of been hitting on it over and over again all semester. Risk is not a single thing, and we're hitting on a couple of the components. You're going to now start seeing this breakout of financial risk and business risk. Business risk is operational risk. Business risk is the risk of how you operate your business on a day-to-day basis, how you function. Financial risk is based upon your capital stack, based upon the securities you have, based upon your debt level and your financial leverage. So this is largely your operating leverage. This is largely your financial leverage. The two go hand in glove to create an environment where you're looking at total risk. So now we get to, how do we optimize the capital structure? How do we make the company structured in such a way from a financial perspective that we maximize return to the common shareholder? The top bullet says, in order to optimize the capital structure, we seek to maximize the price of the firm's stock. Explain to me the theory behind that bullet. You can do that. It's like the entire semester wrapped into a little box with a bow on it.
We don't have to take the final.
No, you'll still take the final.
So I'll take it. So for every dollar that you make, portions of it have to go to something, whether it's the paying off the debt or going to the shareholder. So the way your capital structure is structured should be to have as much as that dollar going to the shareholder.
I bet. You're on the right track. Who else wants to take a stab at it? How do you come up with the value of common stock? What is the value of common stock? What's the value of any financial asset?
How much the market is willing to pay for it.
What determines the market price in theory? Come on, I say it every class. Oh, good. You're almost there. What's discounted?
The cash flow.
The cash flow. What cash flow?
Future.
The future cash flow. Discounted at a required rate of return, which is a measure of the risk. And so when you're maximizing the price of a firm's stock, the reason why you could say, I'm doing that, and that therefore gives me the optimal capital structure, is because the price of the firm's stock is theoretically directly related to the expected future cash flows discounted at a discount rate, a required rate of return, which factors in all the risk. And so if you've got a set of expected future cash flows, and you figure out this is what I got to pay the debt, and this is what I got to pay for preferred stock, and it's got all these risk components, and you go, okay, that expected future cash flow is this, and my company is this risky, therefore I'm using that risk as a discount rate, and you plot that stock price. And then you go, I've got another set of cash flows, and maybe I'm going to use less debt and more preferred stock, and then I've got a different risk, and I plot that stock price, because that's my discount rate. Pretty soon you find that you can graph this stuff out. And it's, when you get into investments, for those of you who take investments, you'll learn about this concept called the efficient frontier. Essentially, a series of risk-return plots which kind of show optimal efficiency. Or for this return, this risk is good, and this is adequate, and then anything within that efficient frontier is you're not getting enough return for the risk you're taking. That's exactly what we're looking for here. We're seeking to maximize the firm's stock price because at some point we're measuring out the cash flows that are coming to the common stockholder. We're going to measure them out in scenario after scenario after scenario after scenario of debt and equity, and scenarios of changes in operational leverage and financial leverage, and scenarios of up and down in the economy and up and down in commodity prices and other things, which we use Monte Carlo analysis, which we talked about in prior class. You plot all these things out, there come a point on there where it goes, based upon all that risk and based upon all those changes in cash flows and all the plots, there's something that rides up at the top, and that would be your optimal capital structure. Changes in debt, the more debt you take, the higher your risk profile. The higher your risk profile, the higher the required rate of return for both equity and for the debt. However, the cost of debt is generally lower than the cost of equity. And so every time you increase the debt, you change the risk profile. The cost of debt changes with the capital structure. If you have a company with 90% debt and 10% equity in a certain industry, and you have a company with 50% debt and 50% equity in a certain industry, all things being equal, operationally, which company's riskier? The first one or the second one? The first one. And so if you're a common stockholder in the first one, are you going to require a higher or lower rate of return? If you're a debt holder in the first one, are you going to require a higher or lower rate of return? Which do you think has a lower cost of capital?
The second one.
It depends. In general, the cost of that debt will be lower than the cost of equity. However, it depends on how high the risk profile is, how high the risk premium is on the debt and on the equity to determine which one's going to have a lower cost of capital. By the way, when you look at a bank, almost any bank has about that 90-10 debt to equity ratio. Banks are notoriously undercapitalized, or excuse me, have a relatively low capital relative to debt, because to a bank, debt includes deposits, because they owe that back to the folks who deposited. So financial leverage increases financial risk, which generally increases the overall weighted average cost of capital. There's another couple ways we can look at how you analyze risk. The earnings before taxes or earnings per share analysis is used to look at capital structures to see how changes in debt and equity impact earnings per share under various scenarios. And again, as you can see here, as long as you're within a relatively narrow scope or a relatively narrow range, earnings per share isn't directly equivalent to value, to stock price, because what we're doing is assuming that the PE ratio, which is what? Price to earnings ratio, is staying constant. We're saying if the PE ratio is 10 and earnings per share goes up, the stock price goes up. And after a while, if the risk profile of the firm goes up, what do you think happens to the PE ratio? It goes down. Because all of a sudden the market's saying, hey, the dollar of earnings in this thing isn't worth as much because it's risky. So the PE ratio may go from 10 to 8 to 6 because there's a high risk associated with those earnings. And so they're not going to pay as much for those earnings because, again, what you're paying for in the market is a discounted expected future cash flow stream. And if you think that that is risky, then your rate of return goes up, or your required rate of return goes up, and things like PE multiples come down because it's riskier. When you're able to optimize the capital structure, it'll maximize the return on your stock, and it also will generally give you a debt to equity ratio that's a little bit lower than one that optimizes your earnings per share or maximizes earnings per share. Why? If you have a company that's profitable, let's assume it's Unilite and it's generally profitable. Why do you think that the debt to assets ratio or debt to equity ratio is lower than that which maximizes earnings per share?
It's not performing as well as other companies in the same industry.
You're overthinking, but you're on the right track. You're on the right track. What if I had one share? Unilite had one share. Kind of. No. You're on the right. I'm actually trying to kind of think it forward. If you had one share, if Unilite had one share, it was 99.99999% debt, and it was earning, once you paid all the interest and you made all the debt payments and the preferred stock payments, you went from a profit of $21 million down to $2,000. Right now, the earnings per share is $1.28. But if you only had one share, it's now $2,000. Do you think that optimizes the value of the firm? 99.9999% debt, 0.0001% equity. But it's $2,000. That optimizes EPS, right? What happens if they don't sell 10 things? They're out of business. They default. Because the operating leverage or the financial leverage is so high that a sneeze breaks the company. So even though EPS is maximized, the value of the firm isn't, because all it's going to do is take buying paper clips wrong, or a small change in an input, or a slight change in a variable interest rate, and all of a sudden the company's out of business. And so you've got to look at the optimal capital structure. The easiest thing to look at when you get questions like this, whether it's on an exam or in real life, is take it to an extreme and go, does it hold in the extreme? Think about it in the extreme. So you say, hey, if you had one share and everything else was debt, does that optimizes earnings per share? For sure. But think about what happens in the event of anything going the other direction, anything not working well, anything coming up, any risk associated with it. So here's a little analysis for an example. The firm can issue debt and repurchase shares of stock at $10 per share based upon the following schedule. So you could have all equity at $400,000, no debt, or 60% debt, 40% equity. For each one of these, as I had mentioned, you can plot out, here's the debt to equity ratio. Here's the cost of debt. Again, if you have no debt, the cost is zero. The more debt you get, the higher the required rate of return on the debt because it becomes riskier and riskier and riskier. And the fewer shares of stock you have outstanding because you're essentially redeeming stock and issuing bonds to buy the stock in the open market. This is, by the way, a relatively common occurrence in the world today. It's a highly controversial one. So if you guys kind of geek out on this stuff like I do, you can read about, there's articles around, should this be made illegal? Essentially, you've got these things called stock buybacks, where right now there's an argument that because the tax bill went through, and so companies have more in their bottom line, the intention was they're going to pass that through to the workers. Well, a lot of companies are going, okay, I'm taking that surplus cash and I'm actually going to use it to buy back shares on the open market. So I'm going to reduce the number of shares outstanding. And therefore, I'm going to drive up earnings per share. It's nothing different than really doing this, going, okay, I'm going to borrow money and buy back stock on the open market and adjust my debt to equity ratio. So you can see that this is plotted out, ranging from all equity to 60-40 debt to equity. And then we take a look at probabilities of things happening. So we say, after operating expenses, what's the EBIT? We say, okay, if it's a boom, the EBIT is going to be equal to the net operating income, 200,000, 10%, 120,000, 60%, and a recession of 40,000, you'll have EBIT or net operating income of 40,000, and there's a 30% probability of that. This is a relatively straightforward analysis. Again, the toughest part in financial analysis isn't what we do here in class. It's actually the fuzzy things behind how do you come up with these probabilities? And what's the impact of the severity of things like the boom and the recession? So the hard part isn't necessarily the math we're doing, it's really trying to get behind the math and try and do that analysis, and you'll get that in follow-on courses. So now we're just going to plot this out. And we're going to go, okay, if we've got a 0 debt to equity ratio, so you can see debt to equity is 0, debt is 0, interest equals 0. Here's my earnings before interest and taxes under each of those scenarios. No interest expense, so my taxable income. Take the tax rate, here's my net income, and here's my earnings per share. So under every scenario here, my earnings per share is positive, ranging from 60 cents a share up to $3 a share. The expected earnings per share, which is just the weighted average of these, comes to $1.56. This is the standard deviation and the coefficient of variation. So you can see essentially what the risk profile is. 0.46 is the CV, which is what we were going to be comparing, as well as the earnings per share. So this is pretty straightforward. We take a second one, and we increase the debt to equity ratio to 20%. So now we have interest expense, which is at 6%. We pay taxes. We have net income. Earnings per share, now we only have 32,000 shares. So earnings per share, you can see under this boom scenario, starts going up. You can see that starts going up. As a matter of fact, across the board, you see increases in expected earnings per share. However, you also start seeing increases in risk, right? You can see the coefficient of variation at the bottom goes from 0.46 to 0.48. We can repeat this over and over and over again, which I'm not going to do. And you build this table. You essentially say at this proportion of debt, here's the expected earnings per share. Here's where it maximizes. Here's the standard deviation. And here's the coefficient of variation. You can see that as debt goes up, risk goes up, expected earnings per share go up, and then at 60%, it tips over. Why do you think it tips over at 60%?
Is it a break even point?
Nope. It surpassed the optimal point, and what happened is once you got into the recession, there was so much debt there you weren't covering, you were starting to show losses. So on the recession piece, when you model this out at 60%, you'll show a loss, and all of a sudden that starts pulling down the expected earnings per share, 30% probability of a loss. And so this is where it says, okay, optimally we should be at 50%. And you can see it graphed out here because I like graphs. So you can see you just plot out the debt to equity ratio at the bottom. You plot out the expected earnings per share. At this point, it maximizes $2.34. You can also see based upon the coefficient of variation here, this is your business risk. So at 0, it came to 0.46. And then you plot it out, and you can see that it increases at an increasing rate. So this would be differential calculus. So you can figure out how rapidly it's increasing. And what you want to do is find a point at which that's optimized, which again is likely to be right there at 50%. And you can see that if you add it out to 70 or 80, the risk is likely to increase dramatically, exponentially, as you move forward, and expected earnings per share is going to decline. Any questions on this concept? Okay, have a great day. I will see some of you in a few minutes, and I will see the rest of you on Wednesday.
So I know I was gone, so I just need the quiz 9 over.
No problem.
Yeah, and that's it. And then for the final, when do we have the final? Is
It is
the last week? Or?
Yeah, Tuesday morning.